Hi there, it's Friday the 14th of February 2020. Happy Valentine's Day. I'm Steve Towers. Welcome to ITB. Let's get started. The biggest international tax news this week by far is the release by the Inclusive Framework of final guidance on the transfer pricing of financial transactions. In fact, this story is so significant that it occupies most of today's video. You'll remember that a non-consensus discussion draft was issued on this topic in July 2018. The final guidance is a consensus report, and that's reflected in a lack of precision in some areas. But nevertheless, this is a significant document. It's the first time the OECD or the Inclusive Framework has provided guidance on this topic. The text in the report constitutes additional material which will be added to the 2017 OECD Transfer Pricing Guidelines. Most of the text is a new Chapter 10 in the guidelines. The last part of the text, dealing with risk-free and risk-adjusted rates of return, will be added to Section D in Chapter 1 of the guidelines. The report does not indicate an effective date for the additional material. Here's the first tranche of topics covered in the report. Please hit the pause button to study this list. And here's the second tranche. Again, please hit the pause button to study the list. For a copy of the report, please go to our website or app. The report commences by addressing a controversial topic: determination of whether a purported loan should be regarded as a loan or should instead be treated as equity. The OECD's preferred approach is that Article 9 of the OECD Model Treaty allows such a rebalancing of debt and equity funding of an entity within an MNE group, and points to the commentary on Article 9 as support. Under the OECD's preferred approach, the balance of debt and equity would be considered and, if appropriate, adjusted as part of the accurate delineation of the actual transaction under Section D of Chapter 1. However, the report acknowledges that this issue can also be dealt with under domestic legislation without resorting to Article 9 and the accurate delineation approach under Chapter 1. The report gives this example of the OECD's preferred approach. Company C makes a loan to related Company B for 10 years. Financial projections show that Company B would be unable to service a loan of that amount. The report says this: consider a situation in which Company B, a member of an MNE group, needs additional funding for its business activities. In this scenario, Company B receives an advance of funds from related Company C, which is denominated as a loan with a term of 10 years. Assume that, in light of all good faith financial projections of Company B for the next 10 years, it is clear that Company B would be unable to service a loan of such an amount. Based on facts and circumstances, it can be concluded that an unrelated party would not be willing to provide such a loan to Company B due to its inability to repay the advance. Accordingly, the accurately delineated amount of Company C's loan to Company B for transfer pricing purposes would be a function of the maximum amount that an unrelated lender would have been willing to advance to Company B and the maximum amount that an unrelated borrower in comparable circumstances would have been willing to borrow from Company C, including the possibilities of not lending or borrowing any amount. Consequently, the remainder of Company C's advance to Company B would not be delineated as a loan for the purposes of determining the amount of interest which Company B would have paid at arm's length. Apart from the balance of debt and equity, the report describes various factors to consider in determining an accurate delineation of the actual transaction. And in doing so, it provides two examples. The first example considers the issue of control over risk. The lender, Company A, does not exercise such control. Instead, such control is exercised by the group parent, Company P, which is not a party to the loan. The report says this: consider a situation where Company A advances funds to Company B. Consider further that the accurate delineation of the actual transaction indicates that Company A does not exercise control functions related to the advance of funds, but that Company P, the parent company of the MNE Group, is exercising control over those risks and has the financial capacity to assume such risks. Under Chapter 1 analysis, Company P will bear the consequences of the playing out of such risks, and Company A will be entitled to no more than a risk-free return. And the second example considers the impact of an M&E group's existing financing policies to an intra-group loan for a term of 10 years, which is used to fund short-term working capital. The group policies include that the group uses 1-year revolving loans to fund short-term working capital. The report says this: consider that Company A, a member of AB Group, advances funds with a term of 10 years to an associated enterprise, Company B, which will use the funding for short-term working capital purposes. This advance is the only loan in Company B's balance sheet. AB Group's policy and practices demonstrate that the MNE Group uses a 1-year revolving loan to manage short-term working capital. In this scenario, under the prevailing facts and circumstances, the accurate delineation of the actual transaction may conclude that an unrelated borrower under the same conditions of Company B would not enter into a 10-year loan agreement to manage its short-term working capital needs, and the transaction would be accurately delineated as a 1-year revolving loan rather than a 10-year loan. The consequences of this delineation would be that, assuming the working capital requirements continue to exist, the pricing approach would be to price a series of refreshed 1-year revolver loans. The report indicates that the new Chapter 10 will apply to the financial services industry, although in a way which will recognise the special constraints of that industry. The report says this: M&E groups operating in different industry sectors may require, for example, different amounts and different types of financing due to different capital intensity levels between industries, or may require different levels of short-term cash balances due to different commercial needs between industries. Where the relevant MNEs are regulated, such as financial services entities subject to regulations consistent with recognised industry standards, for example, Basel requirements, due regard should be had to the constraints those regulations impose upon them. The report makes interesting comments in regard to several topics concerning intragroup loans, security or the absence of security for intragroup loans, the use of credit ratings to determine credit risk, the effect of group membership, and determining the arm's length interest rate. Let me take you through each of these in turn. The first topic concerns security or the absence of security for intragroup loans. The report suggests that security can be imputed to an unsecured intragroup loan under the accurate delineation approach. The report says this: in the case of a loan from the parent entity of an M&E group to a subsidiary, the parent already has control and ownership of the subsidiary, which would make the granting of security less relevant to its risk analysis as a lender. Therefore, in evaluating the pricing of a loan between associated enterprises, it is important to consider that the absence of contractual rights over the borrowing entity does not necessarily reflect the economic reality of the risk inherent in the loan. If the assets of the business are not already pledged as security elsewhere, it will be appropriate to consider under Chapter 1 analysis whether those assets are available to act as collateral for the otherwise unsecured loan and the consequential impact upon the pricing of the loan. The second topic concerns the use of credit ratings to determine credit risk. The report makes some cautionary comments about the use of publicly available financial tools or methodologies to approximate credit ratings. One cautionary comment is this: the credit rating methodology used in publicly available financial tools may differ significantly in certain respects from the credit rating methodologies applied by independent credit rating agencies to determine official credit ratings, and the impact of any such differences should be carefully considered. For instance, publicly available tools generally use only a limited sample of quantitative data to determine a credit rating. Official credit ratings published by independent credit rating agencies are derived as a result of far more rigorous analysis that includes quantitative analysis of historic and forecast entity performance, as well as detailed qualitative analysis of, for instance, management's ability to manage the entity, industry-specific features, and the entity's market share in its industry. And another cautionary comment is this: in conducting a credit rating analysis, it is important to note that the financial metrics may be influenced by current and past controlled transactions, such as sales or interest expenses. If it appears that such controlled transactions are not in accordance with the arm's length principle, the credit rating derived in light of such intragroup transactions may not be reliable. However, the report does envisage that in particular circumstances, an official credit rating for the M&E group can be used to determine the credit risk of a subsidiary within the group. The credit rating of the M&E group may be used for the purpose of pricing the accurately delineated loan, particularly in situations such as where the M&E is important to the group, and thus the level of implicit support can be expected to be high, and where the M&E's indicators of creditworthiness do not differ significantly from those of the group. An M&E group credit rating is unaffected by controlled transactions and reflects the actual basis on which the group seeks external funding from independent lenders. The third topic concerns the effect of group membership. The report identifies two such effects. The first effect is that the external funding policies and practices of group management will assist in informing the form and terms and conditions of the debt the MNE would have entered into with an independent lender, including the pricing, that is, interest rate paid, and all economically relevant characteristics, such as the type of loan, its term, currency, security, covenants, business strategies, and so forth. Although it's not mentioned by name, this passage seems to adopt the conclusions from the Chevron case in Australia. And the second effect is that the MNE may receive implicit support from the group to meet its financial obligations in the event of the borrower getting into financial difficulty. Implicit support from the group may affect the credit rating of the borrower or the rating of any debt which it issues. The relative status of an entity within the group may help determine what impact that potential group support has on the credit rating of a debt issuer. Entities of an MNE group will be more or less likely to receive group support according to the relative importance of the entity to the MNE group as a whole, and the linkages between the entity and the rest of the MNE group, either in its current form or in terms of future strategy. And the fourth topic concerns determining the arm's length interest rate. The report shows a clear preference for the cup method, if it can be used. If it can't be used because of the absence of comparable uncontrolled transactions, the report discusses the use of several alternative pricing methods: cost of funds, credit default swaps, and economic modelling. But the report rejects the use of bank opinions, which state what interest rate the bank would apply were it to make a comparable loan to that particular enterprise. The report says the bank opinion approach would represent a departure from an arm's length approach based on comparability, since it is not based on comparison of actual transactions. Furthermore, it is also important to bear in mind the fact that such letters do not constitute an actual offer to lend. Before proceeding to make a loan, a commercial lender will undertake the relevant due diligence and approval processes that would precede a formal loan offer. Such letters would not therefore generally be regarded as providing evidence of arm's length terms and conditions. The report provides comments on 4 important topics in regard to cash pooling: long-term credit or debit balances in the cash pool, reward for the pool leader, reward for the pool members, and cross guarantees. I will look at each of these in turn. The first topic is how to deal with long-term debit or credit balances in the cash pool. The report says this: a key consideration in analysing intra-group funding arrangements, which might be described as cash pooling, are situations where members of an MNE group maintain debit and credit positions which, rather than functioning as part of a short-term liquidity arrangement, become more long-term. It would usually be appropriate to consider whether, on accurate delineation, it would be correct to treat them as something other than a short-term cash pool balance, such as a longer-term deposit or a term loan. The second topic is the reward for the pool leader. Cash pooling can generate significant savings for an MNE group, principally in regard to avoiding the bank's interest rate spreads between credit and debit balances. The report describes these savings as arising as a result of group synergies created through deliberate concerted action, which of course is an existing subject dealt with in section D.8 of chapter 1 of the transfer pricing guidelines. A key question is, what part of these savings is paid as a reward for the pool leader instead of being shared by the pool members? Consistent with the discussion in section D.8, the report says this: in general, a cash pool leader performs no more than a coordination or agency function, with the master account being a centralised point for a series of book entries to meet the predetermined target balances for the pool members. Given such a low level of functionality, the cash pool leader's remuneration as a service provider will generally be similarly limited. Where accurate delineation of the actual transactions determines that a cash pool leader is carrying on activities other than coordination or agency functions, the pricing of such transactions would follow the approaches included in other parts of this guidance as appropriate. The report provides 2 examples which reflect this approach. The third topic is the reward for the pool members. The report says this: the remuneration of the cash pool members will be calculated through the determination of the arm's length interest rates applicable to the debit and credit positions within the pool. This determination will allocate the synergy benefits arising from the cash pool arrangement amongst the pool members, and it will generally be done once the remuneration of the cash pool leader has been calculated. In other words, the pool members will share the synergy benefits from the pool after deducting the remuneration paid to the pool leader. The pool members will obtain those benefits in the form of interest rates. However, the report does not provide any formulaic approach for the allocation of the benefits amongst the pool members. But the report does say this: it is expected that all cash pool participants will be better off than in the absence of the cash pool arrangement. That could imply, for instance, that all cash pool participants would benefit from enhanced interest rates applicable to debit and credit position within the cash pooling arrangement compared to the rates that they would expect to obtain from borrowing or depositing cash outside of the pool. However, it is important to note that cash pool members might be willing to participate in cash pool arrangements to access benefits from the membership of the cash pool other than an enhanced interest rate, like, for instance, access to a permanent source of financing, reduced exposure to external banks, or access to liquidity that may not be available otherwise. And the fourth topic is cross guarantees. The report adopts a pragmatic approach. As part of the cash pooling arrangement, cross guarantees and rights of set-off between participants in the cash pool may be required. The practical result of the cross guaranteeing arrangement is such that it would be detrimental to the interests of the MNE group not to support the performance of the cash pool leader, and so by extension the borrower. In such circumstances, the guaranteed borrower may not be benefiting beyond the level of credit enhancement attributable to the implicit support of other group members. If the prevailing facts and circumstances support such a conclusion, no guarantee fee would be due, and any support in case of a default from another group member should be regarded as a capital contribution. The report notes that hedging arrangements are frequently used by MNE groups in the ordinary course of business to mitigate exposure to risks such as foreign exchange, commodity prices, and interest rates. It identifies two transfer pricing issues with hedging. The first issue concerns hedges arranged by a group's centralised treasury function on behalf of an operating entity. Where the centralised treasury function arranges a hedging contract that an operating entity enters into, that centralised function can be seen as providing a service to the operating entity, for which it should receive compensation on arm's length terms. The second issue concerns situations where the hedge is matched at the group level but not at the entity level. For these situations, the report expresses caution. More difficult transfer pricing issues may arise, however, if the contract instrument is entered into by the Treasury entity or another MNE Group entity, with the result that the positions are not matched within the same entity, although the MNE Group position is protected. Where offsetting hedging contract positions exist within the MNE Group but not within the same entity, or where contract instruments do not exist within the MNE Group but the MNE Group position is protected, as may be the case with a natural hedge, for example, it would be inappropriate to match the hedges within the same entity or recognise hedging transactions where written contracts do not exist without a comprehensive analysis of the accurate delineation of the actual transactions under Section D.1 of Chapter 1. For example, the existence of a deliberate concerted action to engage in a hedge of a specific risk, and the commercial rationality of the transactions under Section D.2 of Chapter 1. As a threshold point, the report describes two different types of guarantee, legally binding and implied, and clarifies that references to guarantee in this section of the report are to legally binding guarantees. The report says this: there are various terms in use for different types of credit support from one member of an MNE group to another. At one end of the spectrum is the formal written guarantee, and at the other is the implied support attributable solely to membership in the MNE group. In the context of this section of the report, a guarantee is a legally binding commitment on the part of the guarantor to assume a specified obligation of the guaranteed debtor if the debtor defaults on that obligation. The report then distinguishes between two types of economic benefit which the guaranteed debtor can obtain from the guarantee. Firstly, enhancement of the terms of the borrowing, and secondly, access to a larger amount of borrowing. I will look at each of these in turn. In regard to enhancement of the terms of the borrowing, the report says this: the guarantee allows the borrower to borrow on the terms that would be applicable if it had the credit rating of the guarantor, rather than the terms it could obtain based on its own non-guaranteed rating. This increase in credit rating is, of course, generally reflected in a lower interest rate charged on the borrowing. In regard to access to a larger amount of borrowing, the report states that a portion of the borrowing might be treated as an equity contribution by the guarantor to the borrower, which would effectively disallow a deduction for that part of the guarantee fee which relates to the deemed equity contribution. The report says this: where the effect of a guarantee is to permit a borrower to borrow a greater amount of debt than it could in the absence of the guarantee, The guarantee is not simply supporting the credit rating of the borrower, but could be acting both to increase the borrowing capacity and to reduce the interest rate on any existing borrowing capacity of the borrower. In such a situation, there may be two issues: whether a portion of the loan from the lender to the borrower is accurately delineated as a loan from the lender to the guarantor, followed by an equity contribution from the guarantor to the borrower, and whether the guarantee fee paid with respect to the portion of the loan that is respected as a loan from the lender to the borrower is arm's length. The conclusion of an analysis of such transactions may be, taking into account the full facts and circumstances, that the evaluation of the guarantee fee should be limited to a fee on the portion that has been accurately delineated as a loan, and the remainder of the loan granted should be regarded as effectively a loan to the guarantor, followed by an equity contribution by the guarantor to the borrower. For example, on the left side, you'll see the transactions in accordance with their legal form. A third-party lender lends $100 million to the borrower. That loan is guaranteed by the related party guarantor, and the borrower pays a guarantee fee of $1 million to the guarantor, being 1% of the amount of the loan. Then on the right, after the accurate delineation analysis is applied, you can see these transactions. The third-party lender lends $50 million to the borrower. That loan of $50 million is guaranteed by the guarantor, which receives a guarantee fee of $0.5 million from the borrower, being 1% of the amount of the loan. The third-party lender also lends $50 million to the guarantor, and the guarantor makes a $50 million equity contribution to the borrower. In the accurate delineation version on the right, the borrower will be able to claim a deduction for a guarantee fee of only $0.5 million, assuming 1% is shown to be the arm's length guarantee fee. Also, I would think that the borrower's interest deductions would be reduced by 50%, with possibly the guarantor obtaining the interest deductions instead. But strangely, the impact on interest deductions is not mentioned in the report. The report states that implied support attributable to membership of an M&E group is a form of passive association, which is discussed in existing Chapter 7 of the Transfer Pricing Guidelines, and it therefore does not warrant any fee. The report says this: anything less than a legally binding commitment, such as a letter of comfort or other lesser form of credit support, involves no explicit assumption of risk. In the absence of an explicit guarantee, any expectation by any of the parties that other members of the M&E group will provide support to an associated enterprise in respect of its borrowings will be derived from the borrower's status as a member of the M&E group. The benefit of any such support attributable to the borrower's M&E group member status would arise from passive association and not from the provision of a service for which a fee would be payable. The report discusses a number of ways to determine the arm's length guarantee fee. The preferred method, of course, is the cup method. However, this is commonly not able to be applied due to lack of information on comparable uncontrolled guarantee transactions. An alternative method is the yield approach, which sets a maximum fee for the guarantee, the maximum amount that the recipient of the guarantee will be willing to pay, namely the difference between the interest rate with the guarantee and the interest rate without the guarantee, but with the benefit of implicit support and taking into account any costs. However, this maximum fee does not of itself necessarily reflect the outcome of a bargain made at arm's length, but represents the maximum that the borrower would be prepared to pay. In other words, after setting the maximum amount, you still need to work out the arm's length fee based on the relative bargaining strengths of the two parties. Another alternative method is the cost approach, which aims to quantify the additional risk borne by the guarantor by estimating the value of the expected loss that the guarantor incurs by providing the guarantee. Alternatively, the expected cost could be determined by reference to the capital required to support the risks assumed by the guarantor. The cost approach sets a minimum fee for the guarantee, the minimum amount that the provider of the guarantee will be willing to accept, and does not of itself necessarily reflect the outcome of a bargain made at arm's length. The report defines captive insurance as an insurance undertaking or entity substantially all of whose insurance business is to provide insurance policies for risks of entities of the MNE group to which it belongs. Although the focus in this section of the report is on captive insurance, intra-group reinsurance is also discussed. A major transfer pricing issue with captive insurance is whether there is genuine insurance. The report says this: a frequent concern when considering the transfer pricing of captive insurance transactions is whether the transaction concerned is genuinely one of insurance. That is, whether a risk exists, and if so, whether it is allocated to the captive in light of the facts and circumstances. The report then sets out a list of indicators, all or substantially all of which would be found if the captive undertakes genuine insurance business. Here's the list of indicators. Please hit the pause button if you want to study it. The report addresses the issue of group synergies with captive insurance. Where a captive insurance entity is used so that the MNE group can access the reinsurance market to divest itself of risk through insuring risk outside the MNE group, whilst making cost savings over using a third-party intermediary, by pooling risks within the MNE group, the captive arrangement harnesses the benefits of collective negotiation on any reinsured risks and more efficient allocation of capital in respect of any risks retained. These benefits arise as a result of the concerted actions of the MNE policyholders and the captive. The insured participants contribute with the expectation that each of them will benefit through reduced premiums. This is similar to the type of group-wide arrangements that might exist for other group functions, such as purchasing of goods or services. Where the captive insures the risk and reinsures it in the open market, it should receive an appropriate reward for the basic services it provides. The remaining group synergy benefit should be allocated among the insured participants by means of discounted premiums. The last part of the report on risk-free and risk-adjusted rates of return is text which will be added to Section D of Chapter 1 of the Transfer Pricing Guidelines, and not the new Chapter 10. The report says that a risk-free rate of return is the hypothetical return which would be expected on an investment with no risk of loss. Ultimately, there is no investment with zero risk, and the reliability of available proxies for approximating a risk-free rate of return will depend on prevailing facts and circumstances. The report notes that in practice, the interest rate on certain government-issued securities is commonly used as a reference rate for a risk-free return. The report then makes a number of comments on the application of that approach. Comments in regard to currency risk, temporal proximity, and maturity. The report says that to eliminate currency risk, the reference security for determining the risk-free rate would need to be a security issued in the same currency as the investor's cash flows. That is, the functional currency of the investor rather than its country of domicile. When there are multiple countries issuing bonds in the same currency, the reference point for the risk-free rate of return should be the government security with the lowest rate of return, as any difference in rate must be due to differences in risk between the issuers. In regard to temporal proximity, the report says this: the security should ideally be issued at the time or have a similar remaining maturity as the controlled transaction was entered into. And similarly, in regard to maturity, the duration of the reference security should match the duration of the investment, since the duration of an investment will usually affect its price. But the report also acknowledges that to approximate risk-free rate of returns, highly rated government-issued securities are not the only reference, and other alternatives may be considered on prevailing facts and circumstances of each case. For instance, interbank rates, interest rate swap rates, or repurchase agreements of highly rated government-issued securities. The report identifies two possible ways of determining a risk-adjusted rate of return. A risk-adjusted rate of return can be determined under different approaches. For example, based on the return of a realistic alternative investment with comparable economic characteristics or the cost of funds. In regard to the first way, the report says this: it may be possible to find a reasonable indicator of a risk-adjusted rate of return from comparable uncontrolled transactions or by considering realistically available alternative investments reflecting the same risk profile. Depending on the facts and circumstances, realistic alternatives to an intra-group loan could be bond issuances or loans which are uncontrolled transactions. In regard to the second way, the report says this: under an approach based on the cost of funds, the controlled transaction would be priced by adding a profit margin to the costs incurred by the lender to raise the funds advanced to the borrower. That markup should be proportionate to the risk assumed by the lender. In yesterday's webcast, the OECD said that its economic analysis and impact assessment of Pillars 1 and 2 is that together the two pillars would increase corporate income tax revenue globally by up to 4% or $100 billion on an annual basis. To watch a replay of the webcast and to obtain a copy of the slide deck, please go to our website or app. In France, the tax authorities have released a notice on the deferral of the collection of digital services tax. The notice confirms earlier public reports following the agreement with the US government. For a copy of the notice, please go to our website or app. In Australia, the tax authorities have released for public comment a discussion paper on the buyback or redemption of certain hybrid securities. Public comments are requested by the 11th of March. For a copy of the discussion paper, please go to our website or app. In China, the State Council has announced that tax and non-tax measures will be introduced to help businesses and individuals deal with the coronavirus epidemic. Details on the tax measures have not yet been released. In addition, the customs and tax authorities have issued several circulars which grant customs duty and VAT exemptions for the import and transport of goods and equipment for preventing and controlling the virus. In Taiwan, the tax authorities have issued guidance in regard to withholding tax on outbound service fees or business income. The guidance discusses the ability of taxpayers to obtain an advance assessment from the tax authorities in regard to the calculation of the tax base for the withholding tax. For a copy of the guidance, please go to our website or app. The European Court of Justice has decided another case in regard to the issue of whether higher rate dividend withholding tax imposed on dividends paid to non-resident shareholders breaches the EU's free movement of capital. This case concerns Portugal's dividend withholding tax imposed on dividends paid to a Canadian government investment board. The court held that there is indeed a breach. For a copy of this case, please go to our website or app. In Canada, the Federal Court of Appeal has dismissed an appeal by the tax authorities in the Alta Energy case, which was decided by the Tax Court of Canada in 2018. The tax court had held that a Luxembourg company is exempt from Canadian tax on a profit derived on the sale of shares in a land-rich Canadian company under Article 13 of the Canada-Luxembourg Treaty, despite the fact that the use of the Luxembourg company in the structure was specifically to obtain that treaty benefit, and despite Canada's domestic law GAR. For a copy of the Federal Court of Appeal's decision, please go to our website or app. In the US, Altera has filed an appeal to the Supreme Court in regard to its transfer pricing case concerning employee stock option costs. And only 2 treaty developments this week. We've had 1 treaty signed and 1 treaty terminated. Well, that's the way it is this Friday, the 14th of February 2020. I'm Steve Towers. Happy Valentine's Day and have a great weekend.